The S&P 500 has sold off around 3.4% in the last 5 days, and the CNN Fear Greed Index, which basically measures market sentiment, says we're sitting in extreme fear. And if we look at a heat map of the S&P 500 over the past week, there is red everywhere. Now, this is interesting because a lot of these tech stocks have seen a huge run up over the past year, but stocks like Microsoft, stocks like Google are now trading very close to their 52-week low. So in this video, we're going to be looking at 5 different stocks that I believe some of them are actually undervalued, but they're also all trading right at their 52-week low. So let's go ahead and jump into it, and we'll get started with Alphabet Incorporated. That stock ticker GOOG. We have Google. They're currently trading at about $172.61 per share. Now, if we look at them in the last year, yes, they are up about 25.68%, but look at them in the last month now. Down over 16%. Look in the last 5 days. Down close to around 2%. So is this an opportunity to buy Google? Now, when we talk about Google, to start out, if we go and jump over to my stock screener, come up here and plug in Google, all this data will automatically load in. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, immediately what we can see are signs of a high quality company. Revenue per share is growing at a high rate, earnings and free cash flow per share growing at a high rate. The company has a very high returns on their invested capital, above 20% for 4 consecutive years, meaning that basically the projects they reinvest their capital back into are very profitable. The company virtually has no debt when we look at that debt to assets ratio. In fact, if we quickly glance at the balance sheet, the debt to assets ratio is just 0.06. And then, of course, if we look at the profitability / income statement sheet, we can see the company has a very healthy gross profit ratio that's remained pretty steady over the past decade. So let's talk about the valuation for a minute. We go and jump over to my stock valuation spreadsheet, come up here and plug in Google. To start out, let's look at Graham's valuation. We'll go ahead and zoom in and come down here, and we can see the formula laid out for us right here. Now, the first thing we need is our estimated earnings per share, and you can see with the ticker data function, we were able to automatically pull that in, and we're getting 8.92 for the upcoming year. Now, how are earnings projected to grow in the future? And basically, the bear argument for Google is that AI is going to take from their search dominance. But even if we take that into account from analysts and average analyst expectations, we can still see we're getting double-digit earnings growth projections, even some as high as around 17% in some cases. So based off that, if we go with 15 growth rate projection and then basically throw in these other variables, we come to an intrinsic value of about $162 per share. Now, keep in mind the current yield on AAA corporate bonds is quite high compared to how it has been historically over the past few years, which will drag down this valuation. Now, moving forward, if we look at our discounted cash flow analysis, assuming a free cash flow growth rate of about 14% to the future free cash flows of this company, you can see we come to a discounted cash flow price per share of $215. It's quite a bit higher than the current share price, close to around 25%. If we look at this company from a historical multiple valuation, so we're looking how has the company historically been valued, and even if we decide to remove this huge outlier in 2017, we can see the average price to earnings ratio over the past decade sitting at 26.09. Well, for the trailing 12 months, it's sitting at 20.88. So it's 20% cheaper compared to how it's historically traded. And keep in mind, if we jump over to Seeking Alpha, look at that forward price to earnings ratio, even cheaper at 18.77. That's even lower than the S&P 500. And I'd argue Google's very likely to grow their earnings faster than the average company of the S&P 500. Then finally, if we look at the multiples valuation, and this won't be a perfect valuation because obviously none of these tech stocks are the same, but the average PE ratio of these 4 other tech stocks is sitting at 32. If we apply that same PE ratio to Google, they'd be valued about $261.64. So if we jump over to our output tab and average these 3 valuations together, we come to an intrinsic value of $213.25. Current price is about $172, so with a 10% margin of safety, we get an acceptable buy price of $191.92. And with a 20% margin of safety, it's very close to being in that buy range with an acceptable buy price of about $170.60. Keep in mind, in 2024, Google did announce they would start paying a dividend. They're only using about 10% of their free cash flow to pay out dividends, but it's likely they'll grow that dividend at a pretty high rate moving forward. Next up, we have Microsoft Corporation, stock ticker MSFT, which is a pretty large position in my personal portfolio. If we blow up my growth chart, even after the recent sell-off, I'm currently up about 48% on this position. Now, if we look at Microsoft again, over the past year, down around 6.37%. And if we look at this company from a dividend perspective, I'll plug in Microsoft. Again, thanks to ticker data, the data will load in. Starting dividend yield is currently sitting around 0.81%, but this is a company that has a very nice history of increasing those dividends. And one of the things you have to make note of also is the free cash flow payout ratio has actually been decreasing over time. What does that mean? Well, even though the company is increasing their dividends at a pretty high rate over the past decade, 9.37%, free cash flow has been growing even more. So if we look at this charted out, free cash flow is growing at a very high rate, meaning those dividends are very sustainable and can grow at an even higher rate moving forward. That's definitely something that I personally like to see. Now, if we look at the stock screener for Microsoft, come over here and plug in MSFT. What we can see is actually definitely some similarities with Google. Top lines and bottom lines have been growing at a healthy rate. The debt to assets ratio is getting even healthier, and they have high levels of return on invested capital. So as we all probably know, Microsoft is obviously a very high quality company, but what about the valuation? This has been considered a pretty expensive stock now for a while, and at one point it was trading close to around $450 per share. Looks like even above $460 per share. So the sell-off has been somewhat significant, down to $388. Well, if we jump over to our valuation, let's come up here and plug in MSFT. To start out, if we look at them from a discounted cash flow analysis perspective, assuming a 15% free cash flow growth rate moving forward, you can see we come to an intrinsic value of about $343, which is actually still a little bit below that current share price. Now, if we look at the historical multiples valuation, what we can see is for the trailing 12 months, the PE ratio is around 31.15, but the average PE ratio over the last 10 years still sitting at about 28.82, so it's actually just a little bit more expensive compared to how it's historically traded. But do keep in mind, if we look at it on a forward-looking basis, that PE ratio drops down to about 29.47. If we keep moving forward, look at the multiples valuation. Using Apple, Meta, and Amazon as comparables, again, not a perfect comparison, but the average PE of 32.5. If we apply that to Microsoft, the intrinsic value would be around $405 per share. Then finally, if we use a dividend discount model valuation, assuming a dividend growth rate of 8.25%, we come to a dividend discount model price per share of $456. So if we look at the valuations we used and average them together, we come to an intrinsic value of about $401.70, which it looks like it's about 3.3% higher than that current share price. So with a 10% margin of safety, your acceptable buy price would be around $361.53, but I would also argue it's going to be very rare you get opportunities to buy such a high quality company at a valuation with a 10% margin of safety. And I mean, when we think about Microsoft, this is from their recent earnings report. Look how many products and business segments they have, and look at the rate that they're growing at. I mean, we're talking about 19% growth in some of these products. We're talking about 31% growth, 34%, 21%. This is almost a miniature tech ETF in itself. So all in all, yes, Microsoft certainly could go lower. Who knows what's going to happen moving forward, but it's clear that valuation is starting to become attractive again. Our next stock at a 52-week low is one that has quietly been a quality compounder over the past decade or so, and that's ODFL, Old Dominion Freight Line, trading at $175 per share, and over the past year, down quite a bit, 22.78%. And if we look at the last month, now down around 4.11%. Now, if you're not familiar with this company, they've grown their dividend and their free cash flow at a very high rate over the past 5 to 10 years. Now, the starting dividend yield is low because they just initiated their dividend over the past decade, but look at that 5-year dividend growth, around 28%. And they only use about 25% of their free cash flow to pay out dividends, meaning they should be able to grow that dividend at a high rate moving forward. And look at the free cash flow growth over the past 5 years, around 12%. Over the past decade, they've gone from around, it looks like about 23 to 24 million, all the way up to 887 million in free cash flow. So that's pretty rapid growth. If we go ahead and jump over to the stock screener, look at the profitability of this company. The gross profit ratio has increased pretty dramatically in a short amount of time. That's a really good sign. It's a sign of a competitive advantage. If we jump over to the stock screener and plug in ODFL, what we can see over the past decade, revenue per share has grown pretty significantly, but it's stagnated a little bit over the last few years, and same is true with earnings and free cash flow. Now, the debt to assets ratio has been low for the majority of the past decade, but it's also been reduced. The company's buying back shares, and return on invested capital is quite a bit better than you would expect for an industrial stock. So let's talk about this valuation for a minute. The forward price to earnings ratio for the stock is quite high. It's sitting at 30.64. By most standards, that would be considered pretty expensive, but obviously that actually depends on how fast they can grow their earnings. So let's look at the earnings estimates for this company. Now, earnings aren't projected to grow at a very high rate over the next year, but moving forward, they're expecting double-digit earnings growth for the next few years. So there's still pretty good earnings growth potential according to most analysts. But if we go and jump over to the stock valuation sheet And look at a discounted cash flow analysis perspective. Let's assume they grow free cash flow at about 10% over the next decade. That might be a little bit on the low end according to most analysts, but what we can see is we come to a DCF price per share of just $114. That's significantly lower than the current share price, about 35% lower. If we look at the historical multiple valuation, we can see for the trailing 12 months, that PE ratio about 31.6, while the average over the past decade for this company is 26.4. If we look at the dividend discount model, this is where things look quite a bit better. Assuming 8% dividend growth, which should be very achievable for this company, the dividend discount model price per share gives us $224.64. So from what we've seen, this is a high quality company, good returns on invested capital. They become more profitable when it comes to the profitability ratios, and free cash flow is projected to grow at a high rate, but you definitely have to pay the premium for all of those things. Keep in mind, it'll be interesting to see how tariffs might impact this company, and they also have short interest sitting at about 4.61, which is probably a little bit higher than I typically like to see it. Fourth on the list, we have ASML Holdings, stock ticker ASML, trading at $708.22 per share, and this stock was actually the most recent addition to my portfolio. I added it just around a month ago, and I'm currently up about 4.76% on this position, but obviously I'm going to be holding it for the long term. Now, if you're not familiar with this company, it's important you understand what they do and why they have a competitive advantage. They're a leading developer and manufacturer of advanced semiconductor equipment systems, primarily known for its lithography machines. But that statement doesn't paint the whole picture. If we come down a little bit further, ASML has established a strong market position with a near monopoly in the EUV lithography market, which is crucial for the production of the most advanced semiconductor chips. So not only are they already in a very high growth sector, a high growth industry with AI exploding, but they have a near monopoly with their technology. So we're talking about rapid growth and a wide moat. So for example, if we look at earnings projections for this company, we're talking about over 20% earnings growth for the next few years and then high teens. Now, when it comes to valuing a stock like this, it's a little bit difficult to use more of the traditional models, but what we can do is use what's known as a reverse discounted cash flow analysis. So for example, what we're doing is we're seeing how much free cash flow growth the market is currently pricing into the stock. And if we assume 0% free cash flow growth over the next decade, the company would be worth about $339 per share. But they're trading at $708. So logically, it's telling us the market is pricing in growth. So let's bump this up to 5%. Reverse DCF price per share, $471. At 10%, $657. If we bump it up to around 12%, we actually get above the current share price. So let's pull it back to 11%, and we start getting very close to the current share price for this company. So it looks like at about 11.1%, we get the exact current price for this company. So the market is currently pricing in 11.1% annual free cash flow growth. The question we have to ask ourselves is, do we think it'll be higher? Because if so, the company's undervalued, or will it be lower because then the company would be overvalued? And in my opinion, I certainly think free cash flow growth will be higher than 11.1% for this company moving forward. And as we just saw, I think the analysts tend to agree, especially over the short term. So this certainly looks like an opportunity, but I do also want to point out what the management team has told us is they do plan on increasing that dividend as earnings continue to increase. And the starting dividend yield is currently close to about 1%, but obviously there is immense dividend growth potential. The 5-year dividend CAGR is close to about 18%, and the company doesn't use most of their free cash flow to pay out dividends. So again, we're going to see earnings grow at a high rate, we're going to see the dividends grow at a high rate, and I do think the company's undervalued based on a reverse discounted cash flow analysis. And then finally, we have United Health Group Incorporated, stock ticker UNH, trading at $474 per share, and over the past year, pretty flat, down about 1.51%, but it's been a rocky ride overall. And if we look at them year to date, down about 6%, and in the last month alone, now down 13.2%. Now, if you're not familiar with this company, look at them from a dividend perspective. What we can see is that starting dividend yield is about 1.72%, but there is a very nice history of growing that dividend over time. The 10-year dividend CAGR is about 16% and the 5-year at 11%, and they don't use much of their capital to pay out dividends. So this has been a great dividend growth stock over the past decade. If we look at them on the stock screener, what we can see is top lines have very predictably, very consistently grown over the past decade. But when we look at earnings, the same is almost true until 2024. So what happened here? Well, we have to take a step back here and remind ourselves United Health underwent a cyber attack and had to pay some fines because of this. And they talked about this in their recent earnings report, and without going into too much detail, basically this lowered their earnings per share. But with that being said, it doesn't really hurt their future earnings growth potential. So that's something we do have to keep in mind. So when we jump over to the stock valuation for this sheet, start out, let's look at the discounted cash flow analysis. Assuming just an 8.5% free cash flow growth rate, we come to a discounted cash flow price per share of a little over $500 per share. If we move forward, look at the historical multiples valuation. What we can see is for the trailing 12 months, it's about a 30.5 price to earnings ratio when the average is sitting at 21.35. So at first glance, it would look like the stock is a lot more expensive compared to how it's historically traded, but we have to keep in mind the PE ratio is going to be impacted by the fact that earnings per share was quite a bit lower in 2024. If we look at the PE ratio on a forward-looking basis, it's sitting at just 15.69. So when you consider that PE ratio, 15.69, while also looking at earnings estimates moving forward, the stock becomes a lot more attractive. We're still looking at projected double-digit earnings growth with a low PE ratio of just 15.7. So finally, if we jump over and look at the stock from a dividend discount model perspective, assuming a dividend growth rate of just 7%, which again, if we look over the past decade, that's been easily attainable for the company, we can see the company is worth about $583.51, which is around 23% higher than the current share price. Yes, there are some potential threats on the horizon with people arguing that basically healthcare insurance needs to be reformed, by all means based on the projected earnings growth, the current PE ratio, and the dividend growth we should see. This company certainly looks undervalued at its current prices. So there you go, those are 5 stocks trading right at their 52-week low. Like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.